Hello everyone, welcome to our today's class. Subject is quite interesting today, and so far we didn't talk about trading psychology, but this plays one of the key roles in the Forex trading. Some of us may think that analyzing the market, getting right information, checking charts, signals, trading signals, and all these things are the key, I would say, in a way. There is trading psychology, one of the key drivers of traders, and this should be considered as important as analyzing and general knowledge about market. And we need to talk more about this because psychology is playing a big role, as I said, in trading in the markets. It's a big thing as talking about trading psychology, and sometimes some negative traits or generating some mistakes are not done on lack of knowledge or lack of experience or lack of information, but I would say more on the psychology. Mistakes are constantly repeated by traders due to the psychology, not due to the lack of knowledge, as many traders have their own way of action and reaction. And this is actually one of the main drivers during their trading, and usually leads them into the wrong direction. So controlling your emotions is one of the key things that every trader should consider and should hardly work on this, because once you are calm and you are focused on trading, then you have a much higher opportunity to end up with the profitable trades, or with the trades that you have planned to make, the profits you have planned to make. But once emotions start driving you, then you are in troubles. On either direction, it's always, most of the time actually, is the negative outcome on your trading, and then this is leading to more troubles, because the trader gets discouraged by making certain mistakes, not realizing that psychological factor was heavily involved, and psychological factor basically drove the trader into these mistakes. So we need to see what are these things, how to recognize them, and the most important thing, how to cope with them, or how to fight them, or how to improve the situation to avoid potential losing trading actions which are negative in its nature, because it's normal, it's human. When a trader makes mistake, or a repeated mistake, then he will become more discouraged, and his way of trading will change, even if he doesn't want to do this. It's a sort of psychological movements that drive trader into the wrong direction, and the repeating mistakes is just a result of all this. So you have to be very careful with these things, no matter if you have a great plan, if you have made good analysis, if you have a clear picture of the market movements and the good expectations and good signals. Once the emotions start driving you, then you might be in troubles. So as a definition, what is trading psychology? Is basically mental behavior of each of us as a traders that drive us, that actually comes has a result emotion which drives our trading decision. So this emotional state basically drives a trader towards success or loss in trading. Usually, if there is too strong emotion on positive or negative side, it usually ends up in the negative outcome. So this is the main thing that needs to be considered once the trader enters the market. So apart from good knowledge, good experience, studying of the market, we need to seriously consider the psychological factor as one of the key points in trading, and we need to learn how to work with our emotions, how to control them, and to avoid making bigger mistakes, because none of us wants to make mistake. So as at the beginning, there we know that there are a number of skills and abilities that we need to have in order to perform successful trades. So what we need to have certain knowledge in about the market itself, then of technical analysis, fundamental analysis. More experience is a plus always. We need to know how the markets work, all their rules and principles, and we need to create the best and the most suitable for us the trading strategy. So this is what we spoke in some of the previous classes. We need to test several strategies until we find something that is the most suitable to our personality, to our trading skills, to our preferences. But apart from this psychological aspect, as we said, is one of the key factors, and traders' mindset should not be ignored, and this as it plays the key role in trading. So what we need to do, what we need to know about this is that during trading, of course, especially if it's volatile market, then we need to act quickly. We need to think fast in order to follow all these things, able to make a quick decision. So when it's a fast market, volatile market, we need to be focused and concentrated. We need to have plan, of course, and we need to follow this plan. Though what we said in the previous sessions, when you have plan, you have to stick to it. And once you fail to follow strictly your plan, means that you are greatly increasing possibility of making loss rather than profit. So this all falls into the psychological factor, as we are all different. Of course, every trader, every human is different, but we need to work on our own improvement. So these are the things that are very important and required for the trading in financial markets. So once we have this, we can see how is the psychology important in this. You can see the diagram that it covers approximately 60% of whole process of trading. So what we have the system as the lowest, the smallest part of trading, with only 10%. Then money management and risk management, something that we spoke in the previous sessions, plays also a big role, 30%, but the rest is purely our psychology. So in order to stay successful and on the right track, you need to learn what is the psychology of trading, what are the key points, and how to work with them in order to make trades successful and avoid losses, of course. So we have the two main types of behavior in the market. We have winning and the losing behavior, and basically it's also it's also connected to the direction of the market. Those who are preferring buying, you have the various type of traders. There are a number of traders who are always looking to buy side, and they're always looking for an uptrend. So this is their focus. This is the way of thinking. On the other side, you have sellers who are following the downtrend. Where is the mistake there? If you are focusing only on one side, you are on track to make mistake. As we said, market is moving in waves, in cycles. It's not one straight line. So that straight line does not exist. If there is a trend up or down, it will last for a certain period of time. It might be very short term trend, couple of hours, couple of days, couple of months, couple of years, depending, but eventually will end. So we have to focus on the market, especially if it's a shorter period of time in case of volatile market. So we have to see the both sides of the market. Focusing only on one make us basically blind for the other side. And when the market reverses, until we realize what's going on, the profit is gone, and we are coming close to the red territory that every trader is trying to avoid. Red territory means losing money and going into margin call, and the worst scenario is wiping out the account, the deposit in the account. So the trader needs to understand and must be aware of this, that gains, what will be the gains in case of winning in the market, but also needs to be fully aware of the size of losses if the market moves in the opposite or wrong direction. So if we are only focusing on one side, for example, uptrend, then we are good as long as the market goes in our direction. But once it reverses and we don't react, we are driven by our psychology, who is telling us, okay, it's maybe a short or shallow correction and is going to continue up. This is already alarm, and we have to be aware of this. So we need to consider and view on both sides to calculate and be aware of every possibility, whether it's winning or losing. So if we don't see the both sides, then we cannot expect to be in the most of the situations, of course not always, successful in our trades. So if trader does not watch both sides, he will end up in the chasing the price. This is very common in the market, and I've seen it many times. When the market goes long up and the trader is long, and then market all of a sudden starts moving lower, and until he realizes, or he doesn't want to realize, or he is driven by his psychology, most probably like greediness, then once he realizes, he comes and executes the selling on the worst price, so increasing his loss, and then he's caught into that cycle, buying at the highest and selling at the lowest. And this is basically the biggest threat of the trading in the market. I'm going to show you how it works. So there is a nice diagram that shows this. The trader makes the analysis of the market, makes his decision, he's optimistic, then he's getting enthusiastic because the market is moving into his direction. Then it becomes euphoria when it reaches certain levels above projected levels that he or she already calculated. And then he sees the market is stagnating. It's moving in the sideways mode. This is the first alarm, and he's getting anxious at the moment. Then the way of thinking goes, it says here it's only a temporary downturn. I'm in for the long term. So if you are in for the long term, then your account should be quite loaded with the money. You cannot play with small amounts on the longer term. This is quite risky, and very likely you will be out soon. And then the market continues to go lower, then the fear starts. And the trader becomes desperate once the market reaches his original level. Actually, when he sees the top of the market, when he's still euphoric, then he gets and buys, and then the market starts moving lower. So there is anxiety, then denial, then fear, then despair, and then it's a panic. The price is moving below his level. He's still thinking that it may in a way reverse, but after the panic, he is capitulating. So there is no way, there is no hope that market will return to the levels that will bring him back to the profits, and he is completely discouraged. and his way of thinking is that market is not going in his favor, so let's liquidate this position with loss, because there is no more point of increasing losses. He's already in loss, so he already made a mistake by buying at the highest. Now he is going to sell in the lowest, and then he starts hoping, feeling relief, optimism, and then this repeats until he wipes out his account. So this is the very common picture that can be seen in the markets. I've seen many traders like this, and despite you try to explain to them that something is wrong with their way of thinking, it's many times quite difficult, because it's psychology. It's not something about knowledge. If I talk about technical indicators or charts or something like this, then I have an argument. I can say you are not right because it's like this. But when it's psychology, then it's in trader's mind, and what he thinks is that he's right and I'm wrong. 100%. And I've seen many things like this, many people losing money just on the wrong direction, driven by not the clear mind, but psychological problem. I would call it problem because the trader becomes completely blind for the market movements, and his way of trading is reflected by this situation in his mind rather than the real situation in the market. So once the circle starts, it's quite difficult to come out. Basically, the best thing is to cut everything and then sit and analyze. First of all, analyze the markets to see where did you make mistakes, and then analyze yourself, analyze your behavior, and be honest with yourself and say these are the points where I made the mistakes because of this and this and this. So once you are aware of the problem, it will be much easier to to overcome the problem and work on improvement. Two main feelings in the market that are basically the biggest enemies of traders are greed and fear. What are greed and fear? They're two sides of the same coin. They're both negative in the final result because they drive the trader beyond a certain realistic situation and realistic thinking and analysis. It's just something that picks you up. It's like feeling in the casino. Let's say when someone comes and he's so enthusiastic that he will make money in casino, and then passes through all these stages until he comes out of the hotel or casino broke completely. So fear is basically a natural reaction to what a trader sees as a threat. So when they hear some bad news, some signals, not necessarily to be 100% sure about this, it's enough to start thinking negatively, and this fear then rises in their mind, and there is a fear of that market will move in the wrong direction and wipe out their existing profits or drive them into losses, and forces the trader to avoid any risk, anything that could be strategy at that moment. We have certain strategy, plan A, plan B. So let's move to plan B to see what's going to happen. We'll protect our position with the stop loss, but it might not be so bad. No, they react immediately and then they just cut their position. And in a way, it's good because the market may go in that direction further. And by this reaction, we avoid losses, but can also result in missing potential gains if the market reverses and goes in the right direction, the one that we wanted to go and we expected to go. So we are at zero, basically, without having chance to react properly, just driven by fear. So what we need to do is to understand this feeling. In this case, it's a fear. We need to understand the source of this and why we are afraid of this. And then once we understand, it's the best way of getting rid of the problem is when you understand what is the problem. So you are half cured, let's call it this way, when you understand your problem. Many traders are not aware of this, and they keep pushing in the wrong direction, and always something is guilty, not them. Of course, US jobs came in very negative number, and I was expecting much better, and I lost money, and these are excuses. It is your fear that draw you into something unwanted, and this is a reaction. So it's a reaction on something. That's something. Once you learn what is it, then you can fight it, and you can skip this risk and return back to the right track. I know some traders, particularly I know the trader who is trading for a number of years, and he's still having fear. It's something that he cannot control. And we faced this years ago. He opens the position. If the price ticks 1-2 ticks below, that's it. He needs to cut his position. It's risky. And when asked, no, that's how it is. It's a risk management. It's not risk management if you are just reacting on any move of the market. Risk management is something that you put the stop. If it hits. If it doesn't hit, then you will keep your position. So the guy did not improve. Basically, it's not that much as it was at the beginning, but still, the fear is driver number one in his trading. And you can see from the results, when I see the statement of the trades, you can see from the amounts, and if you compare them with the chart, you can see that he panically reacted in number of trades, just in case he was thinking that the market may move in the wrong direction. So it's fear. Straight away, cut the position. I don't want to think about this. So it's in a way positive that can prevent some bigger losses, but on the other side, it could be also negative, because it could stop you from making some more significant profits. So what we said about fear is that we need to analyze this fear. So we have to talk to ourselves. We have to understand what we are afraid of, what is the source, what's the where it comes from, and then we can work out on overcoming this problem. Because, as I said, once you know the reason of your pain, for example, then you can easier fight it, and you will solve not half, but quarter or 30-40% of that problem, because you know what bothers you. The problem is when you don't know. So a trader needs to understand its psychological state, his immediate reaction on this, because the reaction on fear is this panic selling or panic out of position. So it will drive us nowhere at the end of the day, because on panic reaction and every move of the market, we are not going to make a successful trade. Recall that we spoke about planning the trading strategies, risk management. So if you have all these things, then you don't need to have a fear. You have already a mechanism to protect you and mechanisms to support you when you are on the right direction. So it's just a matter of managing this risk policy by moving stop losses, increasing or decreasing, by increasing your profit limits. But then we come to the other important things. Greed. Greed is, as I said, the second part of the same coin. It is also in a way negative feeling, because it's overdoing. It's pushing the trader beyond the reality. So greediness basically, in my experience, in my career, killed a number of traders. Killed meaning they have lost their money just because of thinking wrong way, or being too self-confident, avoiding to see the realistic, the real situation in the market, and greed drives the trader to hold a position, winning position. So let's go for another few ticks. It's going to go higher. It's going to go higher, and this is immediately exposing you to the risk, which is increasing. Because if you catch one big move, market, as we said, moves in cycles, in waves. So every action requires reaction. So most of traders think, okay, I caught right uptrend, I got some $5,000, for example, profit. I'm going to take this profit. So a number of traders who are following the trend decide to simply cut the position. So what they are doing, they're increasing supply in the market. So more supply, price down. So until our greedy trader realizes that the price will go down, already started moving down, and he keeps ignoring signals from the technical indicators like deeply overbought stochastic and RSI turning already lower and emerging from overbought territory, which is the signal. Fast moving averages 5 or 10 days, let's say, already turning lower, already creating bear crosses, another signal that we should come out of the position. The move is over. They keep holding their position, trying to catch a few ticks more. This is greediness. So if you have planned to make 5,000, you made 5,000, don't go for 5,100, because you are coming out of your plan. So you are canceling your rule. Your rule was 5,000. So once you made it, no matter how the market will react, you can re-enter the market. But if you have planned to make 5,000, you made it, you need to take this money out. Greediness for $100 or $200 may kill all the profit that you already made. And this what usually happens, because the trader gets stuck into this magic range of buying at the highest and selling at the lowest, and then it goes, it becomes endless story until the account is completely wiped out. So this is increasing risk, exposing basically the trader to the high risk, and it's quite risky. So then the trader needs to do something to overcome this situation. So the right way is to not to jump into market, because greedy traders are usually very confident and overconfident. So they jump into market without having the basic knowledge. Or without having the complete knowledge of the market. We said in previous sessions that it is crucial for a trader to be successful to know, first of all, about markets, about all mechanisms, principles of the market, how it moves, then about all the tools that are available, such as technical or fundamental analysis, news, comments, releases, everything that influence the market movements. Then if the trader risks more than he or she can handle, and this is what I say, for example, when the long-term trader says that this is the long-term position and he has $1,000 in the account, this move, any move in the wrong direction more than his amount, and could be just deeper correction, will wipe him out. So risk needs to be according to the size of your account, according to your possibilities, and not above this. It could be lower. This is again about risk policy and the decisions you make. But one of the main things, my main characteristics of a greedy trader is holding on to losing position for too long. So once the trader makes certain profit, then he's trying to catch this $100 or $200. It's going to go for a few ticks higher, and then I'll come out. I will prove you that I was right, and then the market starts reversing, and then he's going through all these stages, hoping that the market would reverse. We had a great sample of this after the Brexit vote in June 2016, when there was no information, no one knew until the last moment when the news were announced, the results of a vote were announced, how Britain will vote. And when you see the result, 48% or 49 towards 51, 52, meaning that it was very tight. So number of market participants were waiting for this. Once the market started moving once the news were announced, and it was very negative for sterling. Sterling started collapsing. I've seen number of traders buying pound, and on question what is going on, you don't know, maybe it will reverse. I think I mentioned this in one of the previous classes as a good sample. So this is psychology of the trader that drives him against the facts in the market. The facts were that Britain voted for exiting European Union. The news were negative for pound. Pound collapsed, but they kept buying. So this is psychology, and this is something that trader needs to overcome. Now it's going against the main rule that trend is your friend. So if you are going against such a strong trend, it means that something is wrong with you, not with the market. We said that market is bigger than you, and you have to be respected fully, otherwise it will eat you alive. So the psychology drives people into some actions that cannot be explained, cannot be justified, and once they realize they are wrong, they don't realize, basically they realize that they are losing money, but they don't realize that they are wrong personally. There is always something else. So the trader also needs to understand Forex in this case, or any market. It's not scheme that will make you rich quickly, and not to have any unrealistic expectations. It's a business like any other, and you have to put yourself within the parameters that every businessman thinks on in his business plan, how many percent I'm going to gain this year or this month or whatever, but to be realistic. If you say I have $100,000, I'm going to make 1 million in 1 month, that's quite unrealistic. So this is what kills most of the traders. They come so enthusiastic, unexperienced, uneducated about markets, ignoring to learn the basics of the market. And once when they get into this circle, market sees them quickly, and when they wipe out their account, then they realize that there was something. Many traders repeat mistake for a number of times because it's, as we said, it's psychological thing, and it's a problem to recognize, actually to admit that it's his mistake or her mistake. So it's always easier to blame someone else or something else rather than admitting mistake. So this is a funny picture, but it's very true, showing the stages of the trader when he is in this cycle. So when there is a greediness, that trader is euphoric, he is enthusiastic, he is calculating already profits in his mind. He is thinking what he is going to buy with these profits, and not seeing or not being aware at all how the market is moving and what could happen in maybe a few minutes or few hours. Then there is a hope when the market starts moving in the wrong direction, thinking this is a shallow correction, we are going to jump higher again, and I'm going to take my profits, I'm going to buy a new Mercedes or whatever. And then there is a fear when he realizes that the market is going completely wrong, and in this fear reaction he is repeating mistake, this time on the opposite side. So on greed, the trader is usually jumping into the market at the highest levels and then exiting at the lowest levels. So this is a circle that goes around and around, and the trader needs to realize where is his mistake and how to overcome this mistake in order to go back on track for what we spoke in the previous sessions. So to have plan and all the necessary parameters in order to perform successful trading. So how to overcome the negative impact from fear and greed? You need to talk to yourself as a trader, and you need to create rules. So you need to have the guidelines based on your risk reward tolerance. So basically based on your decisions on how much you are how much you're planning to make money and how much you are willing to lose. Without both things, you are not going to succeed. If you just think how much I'm going to make, means that I'm not thinking that market may move in the opposite direction and I may lose all my money. So we have to have strategy. We have to have all this put down and followed strictly. And the most important is to take emotion out. So we need to be calm when trading, focused on trading. We do not, okay, this is a quite a difficult job and takes time, but I cannot say it's impossible. It is very possible. And this is very important. So bear in your mind that a trader who is driven by his emotions is usually not a successful trader. You may catch sometimes some positive movements on your optimistic feelings and thinking, but generally it's always leading towards negative outcome, a negative result, and we are trying to avoid these things. So trader need to take emotion out and needs to focus on the market itself, principles of the markets, how it functions, technical fundamental analysis, plans, and everything together, and of course risk policy that will lead towards successful trading without emotions. Otherwise, it could be quite risky. Also, the important thing is to play with the money, play with the amounts. So you need to consider and put the limits on the amount you are winning, you are planning to win or to lose in a day, in a hour, in a trading session, depending on your trading plan. So once you have this plan, this is again risk policy, something that we spoke in the previous one of the previous sessions. And the best thing, I think I mentioned this already, if the profit target is hit, then you just take your money and go fishing. I remember I said this. And if you lose the money, then the same thing, just close your computer and go home. It's pointless to stay in the market in both directions. So basically, yes, if you make once or twice or three times profits, do not jump too much into it, because then you are becoming overconfident and you are becoming euphoric, and of course you are greatly increasing possibility of making a mistake. And on the other side, of course, if you lose certain amount of money, this is the signal that you should stop and just exit the place for the time being. You come next day, you come next week or next month, depending. But you need to calm down. You need to analyze in both sides. I'm not saying that only if you lose money. If you make money, you have to also analyze how did you make it, so you have a sort of model how you will react in the future. At least you have general direction how you will react. And of course, when there is a loss, you have to realize, analyze it, analyze all aspects of this negative trade, find out and spot the mistakes, extract them and analyze and see where was the mistake. So once you make mistake, you are not going to repeat it. So these are the most important things about trading psychology. I would like to see if you have any questions after this. You can find a lot of materials about trading psychology in the net, so you can educate yourself more. But this is important for you as a trader or potential trader, as much as knowing the market, knowing the principles, knowing the analysis is important. Psychology is also very important, and you have to work hard on this and consider it as half of your potential problem. We believe and hope that will be potential, not a real problem, because if we enter the market and we did not solve this psychological problem, then we are in troubles. Of course, it's not easy job. Psychology is quite tough thing to fight with, but you have to work hard on this, and I think results will be positive.